Good day, gentlemen. Today we are looking into Chapter 2. This chapter focuses on asset classes and financial instruments. The learning objectives for this chapter is first to distinguish among the major assets that trade in money markets and capital markets. The second thing is to describe the construction of a stock market index. And finally, to learn how to calculate the profit or loss on investments in options and futures contracts. So basically, we'll look at different financial instruments and different asset classes, including the money market, the bond market, equity markets, and we'll differentiate between stocks and bonds. And after that, we'll look into different market indices and derivative markets. So let's get started with the money market. So talking about the money market instruments, here in front of you you see a list of uh, different money market instruments. But before we look into those in a little bit more detail, we first need to understand what is a money market instrument. The money market is a subsector of the debt market, and it consists of very short term debt securities that are highly marketable. Many of these securities trade in large denominations and so are out of the reach of individual investors. Money market mutual funds, however, are easily accessible to small investors. These mutual funds pool the resources of many investors and purchase a wide variety of money market securities on their behalf. So we can, according to that, we can define money markets as markets that include short-term, highly liquid, and relatively low-risk debt instruments. Examples of these would be Treasury bills. This is the most commonly uh, or the most obvious example of a money market instrument. We have certificates of deposits, commercial paper, bankers' acceptances, and euro dollars, repos and reverses, brokers' funds, federal funds, LIBOR or the London Interbank Offer Rate. Uh, we will start looking closer to at the bills first. Now, looking at the Treasury bills, which is a term that you might have heard of before over your studies. These are U.S. Treasury bills, so they are issued by the federal government in the United States, and they are usually called T-bills for short, okay, or even bills. These are the most marketable of all money market instruments. The T-bills represent the simplest form of borrowing, where the government raises money by selling bills to the public. The investors then go ahead and buy these bills at a discount from the stated maturity value, and then the bill's maturity, or at the bill's maturity, the holder receives from the government a payment equal to the face value of the bill. The difference between the purchase price and the ultimate maturity value represents the investor's earnings in this case. So we could define treasury bills as short-term government securities issued at a discount from face value and returning the face amount at maturity. The T-bills are usually issued with an initial maturity of 52 weeks, so basically a year. Individuals can purchase T-bills directly from the Treasury or on the secondary market from a government securities T-bills directly from the Treasury. Okay, so they can either buy these directly from the the Treasury or in stock in T-bill exchanges. Okay, the T-bills are highly liquid. That is, they are easily converted to cash and sold at low transaction cost and with little price risk. And unlike most other money market instruments, which sell in minimum denominations of 100,000, the T-bills sell in minimum denomination of only $100, although $10,000 denomination are far more common. Okay, so the basic points that you need to understand is who issues those treasury bills, which is the federal government, the denomination of these T-bills. Uh, they are commonly traded at 10,000, but they can be issued also at 100. They mature anywhere between 4, 13, 26, or 52 weeks, but the most common ones are the 52 weeks maturity uh, uh, length or period, which is basically 1 year. They are considered highly liquid because you can easily trade those or redeem those for cash by selling them to other investors. The default risk is close to zero. So in finance book, you'll notice that these are usually considered a risk-free asset, stating that basically they don't have any risk associated with them. In reality, they have a minor risk, but the risk is very unlikely, which is only in the case of the United States government goes down, then the government would default on these treasury bills. So it's a very uh, unlikely probability, and for that, these are usually used as the standard for risk-free assets. Now, the second type of money market instruments that we're going to look at are called certificates of deposits, and they're usually called CDs for short. What is a certificate of a deposit? A certificate of deposit is a time deposit with a bank. The time deposits may not be withdrawn on demand, so the bank pays interest and principal to the depositor only at the end of the fixed term of the CD. So you basically deposit a specific amount with the bank and you get a certificate of deposit for a fixed term, let's say 1 year, 3 years, and so on. And you cannot withdraw that deposit until that time period is expired. And at the maturity date, you will get your money back plus the interest that is agreed upon in the certificate. CDs issued in denominations larger than 100,000 are usually negotiable. However, that is, they can be sold to another investor if the owner needs to cash in the certificate before its maturity date. Short-term certificate of deposits are highly marketable, although the market significantly thins out for maturities of 3 months or more. So shorter than 3 months, they're much easier to trade. Longer than that period, the longer the certificate of deposit maturity or fixed term is, the harder it's going to be to try to trade those CDs. Um, Short-term CDs or the CDs are treated as bank deposits. So basically, just like when you deposit your money in a bank for a time period, so these are treated as bank deposits by the Federal Deposit Insurance Corporation. So they are insured for up to 250,000 in the event of a bank insolvency. Of course, this applies to the United States. So up to 250,000 amount, the Federal Deposit Insurance Corporation covers that uh, under an insurance policy in case the bank goes down and goes insolvent. You can um, um, be compensated for your money or for your deposit back up to 250,000. Anything over that amount uh, is not covered. Also, one thing to note is that interest income that is generated by the CDs is fully taxable in the United States. Okay. The next money market instrument we're looking at is called commercial paper. They're also usually referred to in short as CPs. The typical corporation is a net borrower, as we know, of both linked-term funds um, and short-term funds. Okay, the large, well-known companies often issue their own short-term unsecured debt notes directly to the public instead of borrowing from a bank. These notes are called commercial paper. Uh, Sometimes these are backed by a bank line of credit, which gives the borrower access to cash that can be used if needed to pay off the paper at maturity. So we can basically define them as short term unsecured debt issued by large corporations. These are usually denominated in $100,000 minimum. They mature within a maximum of about 270 days, and the typical term or maturity date for these is between 1 and 2 months. Liquidity wise, these are three. If their maturity is less than 3 months, these are um, usually liquid. Okay, if longer than that, then it gets harder to trade. The default risk, these are unsecured, so they are rated mostly high quality based on the creditworthiness of the corporation, of course, that issued those commercial papers. How is the interest paid on these commercial papers? It's similar to T-bills, so they are sold on a discount, and then at maturity, the full amount or of the face value of the commercial paper is paid out to the investor. Taxation wise, the interest income is also fully taxable, and there is a new innovation in the financial markets that is called asset backed commercial paper. Okay. The next example we're looking at is called bankers' acceptances. A banker's acceptance starts as an order to a bank by a bank's customer to pay a sum of money at a future date, typically within 6 months. At this stage, it is like a post-dated check, and when the bank endorses the order for payment as accepted, it assumes responsibility for ultimate payment to the holder of the acceptance. And at this stage, the acceptance may be traded in secondary markets, much like any other claim on the bank. Bankers' acceptances are considered very safe assets as they allow traders to substitute the bank's credit standing for their own. They are used widely in foreign trade where the creditworthiness of one trader is known to the trading partner, and acceptances sell at a discount from the face value of the payment order, just as T-bills as well. And then at maturity, the full amount is paid out to the investor that holds the banker's acceptance. So we can basically define these as an order to a bank by a customer to pay a sum of money at a future date. Next, we're looking at euro dollars. Euro dollars are dollar denominated deposits at foreign banks or foreign branches of American banks. And by locating outside the United States, these banks basically aim to escape regulation by the Federal Reserve Board. Despite the tag euro, these accounts need not be in European banks, although that is where the practice of accepting dollar denominated deposits outside the United States began. Most Eurodollars deposits are for large sums, and most are time deposits of less than 6 months maturity. So we could define these as dollar denominated deposits at foreign banks or foreign branches of American banks. Now, another very important instrument is the federal funds. Just as most of us maintain deposits at banks, Banks maintain deposits of their own at the Federal Reserve Bank in the United States, or the Fed for short. Each member bank of the Federal Reserve System is required to maintain a minimum balance in a reserve account with the Fed. The required balance depends on the total deposits of the bank's customers. Funds in the bank's reserve accounts are called federal funds or Fed funds. At any time, some banks have more funds than required at the Fed. Other banks, primarily big New York and other financial center banks, tend to have a shortage of federal funds. In the federal funds market, banks with excess funds lend to those with a shortage. These loans, which are usually overnight transactions, are arranged at a rate of interest called the federal funds rate. And this is basically what the Federal Fund Reserves uh, uses or controls the interest rates in order to help stimulate economies. So if you notice few maybe a month or two back, you might have heard in the news that the Federal uh, Reserve Bank have reduced the interest rates. When you hear that term, it basically refers to the interest rates applied to these overnight loans between banks in between their federal funds. So one bank having a shortage borrowing from another bank with a surplus in their funds. So although the Fed funds market arose primarily as a way for banks to transfer balances to meet reserve requirements, today the market has evolved to the point that many large banks use the federal funds in a straightforward way as one component of their total sources of funding. Therefore, the Fed funds rate is simply the rate of interest on very short term loans among financial institutions. While most investors cannot participate in this market, the Fed funds rate commands great interest as a key parameter of monetary policy. Okay? So in simple terms, we can define these funds as funds in the accounts of commercial banks at the Federal Reserve Bank. We also have the LIBOR market, which stands for the London Interbank Offer Rate. This is the rate at which large banks in London are willing to lend money among themselves. This rate has become the premier short-term interest rate quoted in the European money market and serves as a reference rate for which range of transactions are traded. A corporation might borrow at a rate equal to LIBOR plus 2 percentage points, for example. Like the Fed funds rate, LIBOR is a statistic widely followed by investors. LIBOR interest rates may be tied to currencies other than the US dollar. For example, LIBOR rates are widely quoted for transactions denominated in British pounds, yen, euros, and so on. There is also a similar rate called Euribor, European Interbank Offer Rate, at which banks in the Eurozone are willing to lend euros among themselves. We also have repurchase agreements. These are basically short-term sales of government securities with an agreement to repurchase these securities at a higher price. Dealers in government securities use repurchase agreements, also called repos or RPs, as a form of short-term, usually overnight borrowing. The dealer sells securities to an investor on an overnight basis with an agreement to buy back those securities the next day at a slightly higher price. The increase in the price is the overnight interest. The dealer thus takes out a 1-day loan from the investor. The securities serve as collateral for the loan. The term repo is essentially an identical transaction, except the term of the implicit loan can be 30 days or more. Repos are considered very safe in terms of credit risk because the loans are collateralized by the securities. A reverse repo is the mirror image of a repo here but in this case the dealer finds an investor holding government securities and buys them with an agreement to resell them at a specified higher price on the future set dates. The last key point we want to look at under the money markets is brokers' calls. Individuals who buy stocks on margin borrow part of the funds to pay for the stocks from their broker. The broker in turn may borrow the funds from a bank, agreeing to repay the bank immediately on call, hence the name, if the bank requests it. The rate paid on such loans is usually about 1 percentage point higher than the rate on short-term T-bills. This is a partial listing of T-bills from the Wall Street Journal online. Rather than providing prices of each bill, the financial press reports yields based on those prices. You will see yields corresponding to both bid and asked prices. The asked price is the price you would have to pay to buy a T-bill from a securities dealer, and the bid price is the slightly lower price you would receive if you wanted to sell a bill to the dealer. The ask bid spread is the difference in these prices, which is the dealer's source of profit or the brokerage source of profit. One last instrument we also want to take a quick look on is called the money market funds. These are basically funds that invest in the short-term instruments that comprise the money market. They invest in short-term debt of the highest quality up to an average maturity of 3 months, which is considered to be both safe and highly liquid. Therefore, money market funds are regarded as low risk, low return investments. They maintain a stable net asset value and pay out their revenues as dividends to the investors. You can read more about the uh, money market funds in your textbook on page 31. Check out the section of on the market front where it discusses the situation of European money market funds back in 2008. Considering the differences in all the money market instruments we just discussed, you can see that for you as an investor, it's not really easy to compare different money market instruments due to various factors, including the um, par value versus investment value, the year or the calendar year assumption, whether it was 360 days or 365, and 366 in case of a leap year, and also due to the differences between simple versus compound interest. So you need to take these into consideration as an investor when you attempt to compare different money market instruments against each other to decide which one would be more suitable for your investment portfolio. Before we end this section, I want you to take a look at the bank discount rate formula. This is a formula to calculate the discount or the bank discount rate for Treasury bills quotes. Okay, the formula works as follows: the bank discount rate, which is symbolized by uh, return on bank discount, equals the par value of treasury bills, which is the 10,000 minus the price or the market price for the treasury bill, divided by the par value again, which is the 10,000. The first fraction is then multiplied by 360, which is the number of days assumed in 1 year, and those 300 or the 360 is divided by the by n, which stands for the number of days to maturity of the treasury bill. Okay, if we assume the market price for the treasury bill is 9,875, for example, you can do your simple calculations and find out that the bank discount rate for that specific treasury bill is 5%. Here it is also worth noting that we cannot compare treasury bills directly to bonds, and if we need to figure out the bond equivalent yield for a treasury bill, uh, we need to adjust the bank discount rate to make it comparable. We cannot compare the two because of the different maturities, the 360 days versus 365 days a year assumptions, and also because treasury bills uh, return on treasury bills is figured out by the par values versus the price paid for the bonds. So we can adjust the bank discount rate to make those two, uh, meaning the treasury bills and the bonds, or the returns on those two, comparable. We'll see how we can do that in the following slides. So to find the bond equivalent yield using the numbers from our previous example, the past two slides, we can do this simple calculation. This time our formula changes to the par value minus price of the T-bill divided up by the price of the T-bill. Okay, and then multiply that by 365 days this time instead of 360, and divide that number by n, which is the number of days to maturity. So again, using the numbers from our previous example, we can find out that in this example the bond equivalent yield would equal 5.13%. Now we can take our calculations further using the outcomes of um, uh, the bond discount rate of 5% we found out, and um, the bond equivalent yield we also calculated in the previous slide. We could use those as inputs to find out the effective annual yield. Okay, so you use the formula you see in front of you. The effective annual rate equals 1 plus 10,000, the par value, minus the price, divided by the price, and all of this raised to the power of 365 divided by the number of days to maturity. Okay, so using the same numbers or the same price from our example, we can do the calculation and find out that the effective annual yield uh, is 5.23%. Here is a list of the money market instruments that we've covered uh, and associated with the appropriate um, model or formula that we're going to use to figure out the expected return on each one of them. So if you can notice, for treasury bills, commercial paper, bankers acceptances, and repos or repurchase agreements and reserves, we use the discount model, which is basically the first formula that we looked at, the bank discount rate. And on the other hand, certificates of deposits, uh, euro dollars, and federal funds, we use the bond equivalent yield formula, which is the second formula that we looked at. Now we can move on to the bond market. The bond market is composed of longer term borrowing or debt instruments than those that trade in the money market. This market includes treasury notes and bonds, corporate bonds, municipal bonds, mortgage securities, and federal agency debts. These instruments are sometimes said to comprise the fixed income capital market because most of them promise either a fixed stream of income or a stream of income that is determined according to a specified formula. In practice, these formulas can result in a flow of income that is far from fixed. Therefore, the term fixed income is probably not fully appropriate. It is simpler and more straightforward to just call these securities either debt instruments or bonds. The first one we're going to look into is the treasury notes and bonds. Those treasury notes and bonds are usually issued by the US government in order to borrow funds in by selling these treasury notes and bonds. T notes are issued with original maturities ranging up to 10 years, while T bonds are issued with maturities ranging from 10 to 30 years. Both bonds and notes may be issued in increments of $100, but far more commonly trade in denomination of 1,000. Both bonds and notes make semi-annual interest payments called coupon payments. So named because in uh, pro or pre-computer days, investors would literally clip a coupon attached to the bond and present it to receive the interest payments. Okay, so based on that, we can simply define treasury notes or bonds as debt obligations of the federal government with original maturities of 1 year or more. Now, one common variation of treasury bonds is called treasury inflation protected securities. Uh, in the United States, these inflation protected treasury bonds are called TIPS. Okay, and these are basically provided by governments to protect the investors against inflation. So the principal amount of these bonds is adjusting in proportion to uh, any increases in the consumer price index, which, as you might know already, a measure of inflation. Therefore, they provide a constant stream of income in real inflation adjusted dollars, and the real interest rates you earn on these securities are risk free if you hold them to maturity. Okay? Now, some government agencies issue their own securities to finance their activities. These agencies usually are formed for public policy reasons to channel credit to a particular sector of the economy that Congress believes is not receiving adequate credit through normal private sources. The major mortgage related agencies are the Federal Home Loan Bank, FHLB, the Federal National Mortgage Association, or most commonly known as Fannie Mae, the Government National Mortgage Association, or Ginnie Mae, and the Federal Home Loan Mortgage Corporation, Freddie Mac. Although the debt of federal agencies was never explicitly insured by the federal government, it had long been assumed that the government would assist an agency nearing default. Um, so those beliefs were validated when Fannie Mae and Freddie Mac actually encountered severe financial distress in September 2008. With both firms on the brink of insolvency, the government stepped in and put them both into uh, conservatorship, assigned the Federal Housing Finance Agency to run the firms, but did in fact agree to make good on the firm's bonds. Okay, so the U.S. government jumped in and helped these corporations to uh, close their obligations and settle the bonds that were issued by these associations. Another category of bond market instruments is municipal bonds. The municipal bonds are issued by state and local governments. They are similar to treasury and corporate bonds, except their interest income is exempt from federal income taxation. The interest income also is usually exempt from state and local taxation in the issuing state. Capital gains taxes, however, must be paid on municipal bonds if the bonds mature or are sold for more than the investor's purchase price. There are basically two types of municipal bonds. The general obligation bonds are backed by the full faith and credit, i.e., the taxing power of the issuer, while revenue bonds are issued to finance particular projects and are backed either by the revenues from that specific project or by the municipal agency operating the project. Typical issuers of revenue bonds are airports, hospitals, and turnpike or port authorities. Revenue bonds are riskier in terms of default than general obligation bonds. An industrial development bond is a revenue bond that is issued to finance commercial enterprises, such as the construction of a factory that can be operated by a private firm. In effect, this device gives the firm access to the municipality's ability to borrow at tax exempt rates, and the federal government limits the amount of these bonds that may be issued. Like Treasury bonds, municipal bonds vary widely in maturity. A good deal of the debt issued is in the form of short term tax anticipation notes that rise or raise funds to pay for expenses before actual collection of taxes. Other municipal debt may be long term and used to fund large capital investments. Maturities range up to 30 years in this case. The key feature of municipal bonds is their tax exempt um, status because investors pay um, neither federal nor state taxes on the interest proceeds. They are willing to accept lower yields on these securities. An investor choosing between taxable and tax exempt bonds needs to compare after tax returns on each bond. An exact comparison requires the computation of after tax rates of return with explicit recognition of taxes on income and realized capital gains. Here you can see the formula for the calculation in front of you. So return on the tax exempt bond equals the return on the taxable bond multiplied by 1 minus the tax rate. Okay. Now that we've already covered the bond market instruments that are issued by governments, we are going to briefly look at private issues, which are basically bonds that are issued by private entities. The One of the main types of private issues is corporate bonds. The corporate bonds uh, are long-term debt issued by private corporations, typically paying semi-annual coupons and returning the face value of the bond at maturity. Okay, so these represent the means by which private firms borrow money directly from the public. Uh, okay, and these bonds are structured much like treasury issues in that they typically pay semi-annual coupons over their lives and return the face value to the bondholder at maturity. Where they differ most importantly from treasury bonds is the risk factors attached to them. Okay, there are agencies that rate or provide risk rating for these corporate bonds or these bonds issued by corporations, and the rating usually ranges all the way from investment grade bonds to speculative grade bonds. Okay, being the investment grade bonds are safer investments with less risk associated with them, unlike the speculative grade where they are highly risky corporate bonds. Okay. We also have mortgage-backed securities, which we looked at briefly in chapter one. Uh, so these are basically a mortgage-backed security is either an ownership claim in a pool of mortgages or an obligation that is secured by such a pool. Okay. Most of these pass through traditionally comprised uh, conforming mortgages, which meant that the loans had to satisfy certain underwriting guidelines, okay, before they could be purchased by Fannie Mae or Freddie Mac. These mortgage-backed securities, as we've discussed briefly in chapter 1, were one of the main causes of the global financial crisis back in 2008. Now we move on to equity securities. Uh, we have two types of equity securities. The first one, namely, is the common stock. Okay, the common stock, also known as equity securities or equities, represents ownership shares in a corporation. Okay, each share of common stock entitles its owners to one vote on any matters of corporate governance put to a vote at the corporation's annual meeting, and to a share in the financial benefits of ownership. Uh, for example, the right to any dividends that the corporation may choose to distribute. The two most important characteristics of common stocks as an investment are its residual claim and its limited liability. Residual claim means stockholders are the last in line of all those who have a claim on the assets and income of the corporation, meaning that in case of liquidation of the company, liabilities would be settled first, and the common stock holders would be paid last if there was any money left on the company's balance sheet. The second most important attribute or characteristic is the limited liability, which basically means that the most shareholders can lose in the event of any future failure of the corporation is their original investment. So if I've invested, let's say $100 in Apple company, in case the company goes down completely, the most I would be liable to lose is that $100 that I've actually invested in the business. Okay, in case there are any more financial obligations on the company, no one can come and claim those financial obligations from me as a limited liability investor. Another equity security instrument is called preferred stock, okay, or the preferred shares. Preferred stocks has features similar to both equity and debt. Like a bond, it promises to pay to its holder a fixed stream of income each year. In this sense, preferred stock is similar to an infinite maturity bond, that is, a perpetuity. It also resembles a bond in that it does not give the holder voting power regarding the firm's management. Preferred stock is an equity investment, however, the firm retains discretion to make the dividend payments to the preferred stockholders. It has no contractual obligation to pay those dividends. Instead, preferred dividends are usually cumulative, that is, unpaid dividends accumulate and must be paid in full before any dividends may be paid to holders of common stock. In contrast, the firm does have a contractual obligation to make timely interest payments on the debt. Failure to make these payments sets off corporate bankruptcy proceedings. And final point, preferred stock also differs from bonds in terms of its tax treatment for the firm. Because preferred stock payments are treated as dividends rather than as interest on debts, they are not tax deductible expenses for the firm. This disadvantage is largely offset by the fact that corporations may exclude 70% of dividends received from domestic corporations in the computation of their taxable income. Preferred stocks therefore make desirable fixed income investments for some corporations. Another type of capital market equity or instruments is what is called depository receipts. These usually American depository receipts or ADRs are certificates traded in uh, the United States markets that represent ownership in shares of foreign companies. Each ADR may correspond to ownership of a fraction of a foreign share, one share or several shares of the foreign corporation. ADRs were created to make it easier for foreign firms to satisfy U.S. security registration requirements. They are the most common way for U.S. investors to invest in and trade the shares of foreign corporations. Now, the returns on capital market securities can come in two forms: the capital gains and the dividend yields. Okay, capital gains are basically the appreciation of value of the securities price or market price, and the dividend yields comes from the cash flow or the cash flows that are paid out by the corporation to its owners on a regular basis, most likely quarterly or annually. Okay, so we have an example here to help us understand how we can calculate the return on a security or on an equity security investment. Uh, if we buy a share of stock for $50, hold that stock for 1 year, collect $1 dividend, and sell the stock for $54. Now, from these data, you can see that the capital gains were actually $4 because we purchased at $50 and we sold at $54. So the difference between those two represents the capital gains. And the dividend yield is the $1. Okay? So what were the dividend yield, capital gains yield, and the total return, ignoring taxes? The dividend yield would equal the dividend, which was paid out, divided by the purchase price, okay, or the price at the time of purchase. So the dividend here is $1. We divide that by the purchase price, which was $50. We get 2% dividend yield. The capital gains yield equals the price at the time of sale minus the price at the time we bought the stock, and both of these are divided by the price at the time we bought the stock. So it's relatively just a return or a basic return formula. Okay, so in this case that would be 54 minus 50 and all divided by 50, which will give us 8% capital gain yield. Now notice uh, capital gains as a dollar amount was $4, but the capital gain yield, which should be represented in a with a rate of return, in this case is 8%. The same also applies for the dividend yield. So the dividend was $1, but the dividend yield is 2%. So when we say yield, we always looking for the percentage of the return. Now to calculate the total return on this investment, we just add the dividend yield plus the capital gain yield. So we get 2% plus 8%, and that would equal 10% for this example. We could also calculate the total profit that we made as a dollar amount, and in this case that would be the capital gains dollar amount, which was $4, plus the $1 of dividends. That would give us $5 profit. Now we move on to talk about stock and bond market indices. Uh, those market indices are mainly used to track average returns of different stocks or different funds, and they also provide a tool for investors to compare performances of managers. Okay, the third use for these indices is to form a base of derivatives, which we're going to talk about a little bit later in this lecture. Now, what are the factors that we need to take into consideration in constructing or using an index is how representative that index is to the market that we want to invest in. Is it broad or is it narrow focused? And how is it constructed? We're going to see different methods of index construction in the following slide. Now, when it comes to construction of indices, there are three main approaches that are used to construct different indices. We have the price-weighted indices, such as the Dow Jones, which might be the most popular one. And a price weighted average is an average computed by adding the prices of the stocks and dividing by a divisor. Okay. Or is the index market value weighted, such as the S&P 500 and the Nasdaq? A market value weighted index is an index return equals the weighted average of the returns of each component security with weights proportional to outstanding market value. The third approach is equally weighted, so it's also called value line index, which takes the average for all stocks regardless of their prices and their value. So each stock in the index take an exact equal weighting. So based on your um, investment strategy, you might consider allocating specific portions of your portfolio in different indices depending on your preference or your investment strategy. How much money you decide to put in each of these indices or each different instrument that we've discussed already would uh, would form the 100% of your portfolio, and regardless and considering your allocation of different percentages of your portfolio to different instruments, that would form the risk tolerance and the shape of your portfolio. Again, just to reiterate, the way market indices are constructed are mainly focused on or built around the weighting schemes or the different weighting methods that are used for each index. So we have the price weighted average, which is computed by adding prices of stocks and divided by a divisor. We have a market value weighted index, which takes the return equal weighted average of returns of each component security with weights proportional to outstanding market value. And finally, we have the simplest weighting scheme, which is equally weighted index, which basically computes from simple average of returns, which takes all the uh, returns of the stocks that are included in the index and divide them by the number of um, the the number of stocks or the number of securities that are included. So if we have 30 stocks, we take the returns of all of these and we calculate the simple average of return by dividing the total returns by the number of securities, which is 30 in this example. This slide uses a TASI or Tadawul All Share Index, which is basically the Saudi stock market, to illustrate the idea about different weighting methods. So this one talks about how TASI is weighted with the formula provided on top. So in your free time, you can come back to this slide or and look at TASI as an example on your own. Now here we have an example of how we can find out or figure out the price weighted series. As you can see, you have a table assuming three stocks, A, B, and C, and you have their initial prices and quantities, and then you have their price and quantity uh, or the end price and quantity. So after changes in price have occurred. We start first by calculating the index value at time 0 using the inputs in the first two columns. So we add up the price of stock A, B, and C together, 10 plus 50 plus 140, and we divide the total by the number of stocks, which is 3, which would give us 200 divided by 3, equaling 66.7. Okay. Now to figure out the end uh, time series, we need to uh, first figure out the new denominator after the change in quantities. So we first hold the price of stocks A and B constant because their quantities have not changed, and we only change or update the price of stock B, being that it is the stock that had an increase in its quantity. So our new calculation would be $10 plus $25 plus 140, all divided by denominator, which is x, which is the number we're trying to find out in this case, and equals the same price weighted value or the weight price weighted value of the index that we calculated from time zero. After we um, do our calculation, we will find out that the denominator would equal 2.625. Okay, we use that denominator in our end time or the price weighting at time 1, okay, for the index, using the end prices or the new prices for the three stocks. So now we use 15, 25, and 150, and we divide them by the denominator figure we found out in the previous formula, which will give us the new price weighted average for the index, which is 72.38. The problems with this method, it has two main issues. The first one is that similar percentage change movements in higher priced stocks cause proportionally larger changes in the index. Okay, just like what's happening right now with the Dow Jones. Okay, and the second issue is that splits arbitrarily reduce weights of the stocks that split in index. So when a stock or a company that is included in the index decides to split its shares, splitting the shares would reduce the weight of that stock in the index, which causes a could be an issue. Now, if we take the same inputs from the previous slide and look at them from the perspective of a value weighted index, we can figure out the change of a value weighted index based on the changes of prices according to the following formula. So we take the new prices and quantities of each of the three stocks and divide them by the old prices and quantities of the three stocks that we have, and then we multiply that fraction by the old value of the index, which was 100 in this example. This calculation will give us the new index weighting, a value weighting for the index of 106.40. Whereas if we apply the same inputs to an equal weighted series, we need to first figure out the changes or the returns on each stock based on the changes in their prices. So we look at the return on stock A. The price changed from $10 per share to $15 per share. We can calculate the simple return by the simple formula of 15 minus 10 divided by 10. That would give us a 50% increase in the or a 50% return on stock A. We apply the same for the remaining stocks and figure out the return on each of them, and then we take the total of those returns and divide it by the number of stocks, which is 3 in this case. That would give us the percentage change in the weight or the value of the equally weighted index. We take the old weighting of the index, which was 100, we multiply it by the new change. We use 1 as the original value, and then we add the percentage change of the new index value. That would give us 100 multiplied by 1.0238, and the new equally weighted index value is based on that 102.38 points. Here you could see a few examples of domestic indices in the United States. These four are probably the most widely known indices globally. The first one is the Dow Jones Industrial Average, one of the oldest indices in the world. It contains 30 blue chip stocks in the United States. This one is price weighted, a price weighted index. The other one is Standard and Poor's 500. This one is a composite index that contains 500 of the largest companies in the United States based on their uh, market capitalization values. And this one is a value weighted index. The other one is the NASDAQ composite. This one includes more than 3,000 firms. This index is also value weighted. Now, the largest one amongst these examples is the Wilshire 5000. Despite the name, it actually contains more than 6,000 stocks, and uh, this index is also value weighted. The last market we're going to talk about today, which is the most recent of these markets, or the youngest of these markets we just discussed in this lecture, is the derivatives market. These markets have seen a significant development in financial markets in the recent years, and they've grown so much during the past couple of decades. So let's first try to understand what a derivative is. Derivatives are a security with a payoff that depends on the price of other securities. Okay? These include futures and options, which provide payoffs that depend on the values of other assets, such as commodity prices, bond and stock prices, or even a complete market index value. For this reason, these instruments sometimes are called derivatives because they derive their value from the value of um, the underlying financial assets they cover. Okay. One type of these derivatives is called a call option, which is basically the right to buy an asset at a specified price on or before a specified expiration date. What this call option does is that it gives its holder the right to purchase the asset for a specified price, and it's called the exercise or strike price on or before some specified expiration date. So an October call option on Apple stock, for example, with an exercise price of $355 entitles the owner to purchase Apple stock for a price of $355 at any time up to and including the option's expiration date in October. So regardless of what Apple's price at that time, it may even have gotten up to, let's say, $370, $380, then the call option holder would exercise that call or that option and would make a profit from the price difference. Okay? So when the market price exceeds the exercise price, the option holder may call away the asset for the exercise price and reap a benefit equal to the difference between the stock price and the exercise price. Otherwise, the option will be just left unexercised. If not exercised before the expiration date, the option expires and no longer has value. Okay, so it becomes worthless. So in case you put a call option on Apple for $355, just like our previous example, and then since that or after that the price of Apple shares goes down, then you as a call option holder would just simply don't exercise your option. On the other hand of this, we have what is called a put option. Okay, a put option gives its holder the right to sell an asset for a specified exercise price on or before a specified expiration date. An October put on Apple with exercise price $355 entitles the owner to sell Apple stock to the put writer at a price of $355 at any time before the expiration in October, even if the market price of Apple is lower than $355. Whereas profits on call options increase when the asset increases in value, profits on put options increase when the asset value falls. So the put is exercised only if its holder can deliver an asset worth less than the exercise price in return for the exercise price. Okay, so these are basically just bids, right? So if you expect a specific stock's price to rise during a specific financial period, let's say a month, then you can put a call option on that stock, and by that you're just basically stating that you expect that stock to rise in value during that month. And based on that, since you have the right to buy that stock at a specific price, after the stock price rises, you are going to make a gain. And on the contrary, for a put option, you basically just betting or speculating that the underlying asset that you're placing a put option on is going to drop in value over the financial period. So when that asset drops in value, you already have your put option, which gives you the right to sell that stock to the put option, the person or the investor or the entity you've placed that put option with. In this figure, you can see a portion of the options quotations for Apple company for the online from the online edition of the Wall Street Journal. Here you can see the price of Apple shares on that date was $357.20. Then you can see in the first two columns they show the expiration month and exercise or strike prices for each option. They have also included a listing for call and put options with exercise prices ranging from 350 to 360. So basically you can see for the months of July, August, October 2011 and January 2012, you have the numbers for different levels of strike prices. You can see the first four rows, for example, for a 350 strike, then the following four rows 355, and then the last four rows 360 strike price. The next columns provide the closing prices, trading volume, and open interest of each option. For example, 43,911 contracts traded on the July 2011 expiration call with an exercise price of $355. The last trade was at $5.60, meaning that an option to purchase one share of Apple at an exercise price of $355 sold for $5.60. Each option contract on 100 shares therefore costs $560. Notice that the prices for call options decrease as the exercise price increases. For example, the July 2011 expiration call with exercise price of $360 costs only $3.15. This makes sense as the right to purchase a share at a higher exercise price is less valuable, right? Conversely, put prices increase with the exercise price. So the right to sell a share of Apple in July at a price of $355 costs only 90 cents, while the right to sell at $360 costs $3.50. Option prices also increase with time until expiration, so clearly one would rather have the right to buy Apple for $355 at any time until October 2011 than at any time until July 2011. Not surprisingly, this shows up in a higher price for the more distant expiration options. For example, the call with exercise price $355 expiring in October 2011 sells for $21.98 compared to only $5.60 for the July 2011 call. Okay. Now these figures and numbers are not really uh, important for us. This is just an example for you to have a better understanding of calls and put options. Obviously, this is a complex topic. At uh, higher education levels, like master's degree and PhD degrees, you would see this specific topic covered in more depth um, in allocated courses designed just to focus on this specific topic. But of course, for the purpose of our course or the scope of our course, we're just trying to understand the main concepts here. Okay. I personally never invested in call or put options. I find them too complex, and also from uh, religious perspectives, these are basically just um, um, more of a speculation than an investing strategy. So you're just bidding on prices, price directions, whether they're going up or down. You're not actually investing in the organization. But a lot of um, seasoned investors and fund managers use these to try and hedge their positions, basically to try and reduce the risk of their investments. We will talk about such topics in future lectures, inshallah. Now let's look at a quick example to try and understand this a little bit better. What would be the profit or loss per share of stock to an investor who bought the July 2011 expiration Apple call option with an exercise price of $355? If we know that the stock price at the expiration date was $365, okay, so there is a $10 difference between the exercise or the call option or the strike price of the call option and the current market price. Okay, in that case, what we need to do is calculate the difference in stock price. Okay, so we would consider that the call option or exercising the call option would cost us a specific amount of money. In this case, $5.60 for one share, so 560 per 100 shares. Okay, so we need to add that to the current to the exercise price that we have, or the strike price that we have, which is the $355, and then compare the total of these two with the current market price. If the total of the strike price and the cost of the call option together is less than the current market price of one share of Apple, then we would exercise the call option and the transaction would be profitable for us. If not, then we don't exercise the option because we would actually lose some money if we did. All right. You have another example in your book, and this example here is also different in numbers. So if the one in your slide assumes that if the stock price was actually equal to 357.20, okay, then in this case you will make money if the stock price increases above 357.20 plus the 560 that you're gonna need to pay to exercise the call option for each share. These two together would add up to 362.80 cents. Okay, so you would compare this amount with the current market price of the stock. All right. Now here's another scenario for you. So using the stock options on Apple, let's assume that you have the right to buy 100 shares of stock at the stock price of $350 using the July contract. Referring back to the figure 2.9 that we just looked at, you would see that the cost for such contract would be $9 per share. Okay, the strike or the strike cost or exercising the option would cost you $90 for the 100 shares total. Okay. Now adding that to the to the um, option or the strike price, which is 350, you get $359. Now comparing that to the underlying stock price, which is 357.20 cents, you could see that exercising this contract would actually lose you money or cost you money. So it wouldn't be wise to exercise this option. Okay. Now the slide also puts forward a question, a conceptualizing question: why do the two option prices differ? Basically, as we discussed, the option price depends on multiple factors: how long you still have until the expiration date, how big is the difference between the strike price and the current market price for the underlying stock. So all of these factors would affect the contract value or the contract costs. Okay, so in this example you see that there is a bigger difference between the current market price of the stock and the strike price. Alright, which is $7.20 in this case. So this makes the contract more costly or more valuable. Alright. Now looking at the same figure 2.9 to try and answer the following fundamental questions. So the first one is: how does the exercise or strike price affect the value of a call option or a put option, and why? And the basic concept here is the biggest difference between the strike price and the underlying stock price, the more valuable the call option or the put option would be. Okay, so that greatly affects the last price of a both call option or put option, of course in both directions. All right, and also the time left for the expiration on the contract itself or the option itself also greatly affects the price of the call option and the put options. The second question is: how does a greater time to contract expiration affect the value of a call option, a put option, and why? We basically just answered that. If you have a call option, for example, for that is expired 1 month from now, of course that is going to be less valuable than a contract that expires 3 months from now, for example, because during that 3 months a lot more could change in the underlying stock price. Okay, and of course the holder of the option itself would enjoy a much longer period to take advantage of that option. Okay, so the chances of the holder of a call option to get an opportunity to exercise the call option, for example, within a 3 or 6 months period, where in case the stock price skyrockets, for example, are much higher since he has a longer period available until the expiration date of the call option. So the longer the period, the more chances he has to or the higher the chance for him to get a profitable opportunity to actually exercise the call option. Okay. The final question is, how is volume different from open interest? Basically, volume in the figure represents the number of options that are actually traded on that month. Okay, whereas the open interest represents the number of outstanding contracts that are available for each option. So they are available for trade for each option. We covered options. Now we look at another derivative market instrument, which is called futures contracts. A futures contract calls for delivery of an asset, or in some cases, its cash value, at a specified delivery or maturity date for an agreed upon price. This is called the future price. Okay, to be paid at contract of or the contract's maturity date. The long position is held by the trader who commits to purchasing the commodity on the delivery date. Alright, the trader who takes the short position commits to delivering the commodity at contract maturity. Okay. So basically we can define futures contract as an obligation by traders to purchase or sell an asset at an agreed upon price at a specified future date. Okay, so where unlike options, who actually provide the holder the right to purchase or sell a specific underlying asset until a specific expiration date, a futures contract actually is a financial obligation to either purchase or sell at a specific future date. Okay. Now let us take a look at figure 2.10, which illustrates the listing of the corn futures contract on the Chicago Board of Trade for July 8, 2011. Each contract calls for delivery of 5,000 bushels of corn. Okay. Each row details prices for contracts expiring on various dates. The first row is for the nearest term or front of the contract with maturity in July 2011. The most recent price was $6.7225 per bushel of corn, and that price is up $0.2225 from yesterday's close. The next column shows the contract's opening price that day, as well as the high and low price over each contract's life. Volume is the number of contracts trading that day, and open interest again is the number of outstanding contracts. Okay, so the same concepts apply here, just like the future or the options. The trader holding the long position profits from price increases. Suppose that at expiration corn is selling for $6.9225 per bushel. The long position trader who entered the contract at the futures price of $6.7225 on July 8th would pay the previously agreed upon price, which is $6.7225 for each bushel of corn, which at contract maturity would be worth $6.9225. So basically he's like buying on discount because he agreed on that price before that expiration date. Okay. Because each contract calls for delivery of 5,000 bushels, the profit to the long position in this case, ignoring brokerage fees, would equal 5,000, which is the number of bushels of corn, multiplied by the difference between the futures contract price and the current market price for the corn, which is simply in this case subtracting $6.92 minus $6.72. That would equal $1,000. On the contrary, the short position must deliver 5,000 bushels for the previously agreed upon future price. So the short position's loss equals the long position's profit. Okay? Now the difference between those, the short seller and the long seller, of course, as a conceptual understanding, the short seller is a person who entered in this futures contract expecting that the underlying assets value would go down over time by the time that by the date of the futures contract, where the long option or the long trader was basically expecting that the assets value would go up. Okay. The right to purchase an asset at an agreed upon price versus the obligation to purchase it distinguishes a call option from a long position, just like I've discussed in the previous slide, specifically in a futures contract. Okay, a futures contract obliges the long position to purchase the asset at the futures price. Okay, so he has no option to decide not to exercise his option, just like in the call option we discussed before. So the call option merely conveys the right to purchase the asset at the exercise price. So the purchase will be made only if it yields a profit. Okay, clearly the holder of a call has a better position than the holder of a long position on a futures contract, with a futures price equal to the options exercise price. This advantage, of course, comes only at a price. So the call options must be purchased. Futures investments are entered into without cost. So the purchase price of an option is called the premium. It represents the compensation that the purchaser of the call must pay for the ability to exercise the option only when it is profitable to do so. Similarly, the difference between a put option and a short futures position is the right, as opposed to the obligation to sell an asset at an agreed upon price. Alright, so I hope you guys understand the difference here between the options we discussed a few slides back and the futures contracts. Referring back to figure 2.10, we could see an example right here. So corn futures prices in the Chicago Board of Trade on July 8th, 2011. Of course, as we mentioned earlier, the contract size is 5,000 bushels of corn. If you look at the price quote for December 12th on the figure, you'll see that the contract, or it says that the contract for December 12th is 6140. Okay, this basically translates to a price of $6.14 plus 0 divided by 8 cents per bushel per corn bushel. Okay, of course the 0 divided by 8 is eliminated because 0 divided by 8 is 0, so you end up with $6.14 per corn bushel. Okay, if you bought the December 12th contract, what are you basically agreeing to do? You're basically agreeing to purchase 5,000 bushels of corn in December for the $6.14 per bushel. So if you multiply that by 5,000, which is the contract size, you get $30,700. All right. What is your obligation if you sell the December 12th contract? Of course, if you sell the contract, you have no obligation. If you sell the contract before the contract maturity, you have no financial obligation based on that, and the person who purchased the contract would have to actually be the one to purchase the 5,000 bushels at the contract price. How does this contract differ from an option? We just mentioned that earlier in this lecture. Basically, for the contract, you are obligating that you are going to purchase or sell specific assets on the contract's maturity. However, for an option, you purchase the right, okay, or the option to either buy or sell a specific asset uh, until an expiration date or a maturity date. Now I understand at this level, for this course, you might find the concepts in this particular topic a little bit confusing, but just to sum up, uh, I need you to understand few key things. So for options, you need to understand that you're basically uh, uh, you are either placing a call option or a put option that gives you the right to either buy a specific asset or sell that specific asset at a fixed price in a future date. Okay, so a call option would be the right to buy the specific asset, and a put option would be the right to sell that asset. Okay, the terms you would need to understand here on top of that is the exercise price or the strike price and the expiration date of the option. Okay, whereas for futures contracts, you need to understand the two basic positions are called long position, where you purchase the right to buy a specific, not the right, actually the obligation to buy a specific asset at a future date, and the short position where you you buy the obligation to sell a specific asset at a fixed price in a future date. Terms in the futures contract that you would need to understand is the delivery date, which is the date of the contract maturity, and the deliverable item, which is the asset or the underlying asset that the futures contract actually covers. Okay, I hope you gentlemen enjoyed today's lecture. As I have mentioned in the beginning, that this particular chapter is quite heavy. I understand that, so please don't be disrupted and don't let this put you off. Just try to understand the different types of financial markets or different categories of financial markets, and understand examples of financial instruments within each financial market. Okay, and pay attention to the different terminology and concepts throughout the chapter. This chapter would be really helpful for your future as a business student, especially if you go on into the financial sector or work in the financial sector, to be able to differentiate between all these financial instruments and asset classes is really key to your future success. I wish you the best of luck. Please feel free to ask any questions that you may have about today's lecture.